Holding the appropriate balance between growth and defensive assets is a critical decision point for every investor. Over time, if left unchecked, growth assets, that is those with higher expected long-term returns such as equities, tend to begin to dominate the portfolio. The result could be that having started with, say, 40% in growth and the rest in defensive assets, a portfolio could end up with the opposite composition and the associated change in risk. The process of rebalancing seeks to realign the portfolio with the agreed balance between growth and defensive assets, thus maintaining an appropriate level of risk in the portfolio on a continuing basis. In some instances, a return may be generated from the rebalancing process, often referred to as a rebalancing bonus, but this is not the primary motivation. As David Swenson, Chief Investment Officer of the Yale University Endowment said, the fundamental purpose of rebalancing lies in controlling risk, not enhancing return. Rebalancing is a contrarian approach to investing, and a common argument levelled against it is the requirement to sell out of assets as they increase in value. The reason for doing so is simple. Whilst we can be confident in the performance of the market to trend upwards in the long term, as human capital and intellectual property are converted to financial capital, we cannot say the same of any specific company, sector, or geographical region. For example, only 4 members of an index representing leading UK companies in 1935 were still among the UK's largest 100 companies by 2012. Buy low, sell high is an often repeated mantra, but it is rarely executed in practice. As the share price of a company increases, investors will habitually succumb to greed and purchase, partly because it's rising and they fear missing out on an opportunity. Eventually, this is likely to be while the shares are overpriced, and consequently, when the rest of the market realizes the disparity between price and value, it is likely that the price will drop, possibly even below the amount originally paid by the investor. As this happens, investors often submit to fear and sell at a time when their investment may now become undervalued. The result can be a permanent loss of capital from which it is difficult to ever recover. As indicated by David Swenson, rebalancing is an important risk and emotion management mechanism. It should be systematic and unemotional, reducing exposure to assets whose weights are above their target percentages and increasing it to those which are below them. At times, it can take a strong stomach to sell out of rising assets and to buy into falling ones, particularly if it needs to be done repeatedly. Yet it is logical, as in the long term, buy low, sell high is likely to prove a more effective approach than the opposite of buy high, sell low. And it also maintains the portfolio at the risk level chosen by the investor in the first place. If you'd like to find out more about investing, please get in touch directly or read the Bloomsbury Guide to Investing.